So, despite the Federal Reserve's best efforts, inflation was 8.2%, which was much higher than projected and an indication that things could get worse with another rate hike planned in less than 3 weeks. What is more worrying is that, despite the fact that housing sentiment is already approaching an all-time low, people are now hoarding cash at the highest level in 10 years, and that inflation is still not going away, with the possibility that a stronger dollar could trigger the next crisis. So let's talk about what this implies, why these figures are getting worse, how this is going to affect your assets, and lastly, what you can do to profit from this event. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Okay, before we get into the specific reasons why inflation has yet to meaningfully reduce, we need to discuss the newest Federal Reserve warning, because it provides us a good idea of what we may expect in the next few months. To begin, at the most recent FOMC meeting, they stated unequivocally that they expect the US economy to develop at a slower than expected rate in this and the future years, meaning that our markets will likely remain essentially flat for some time. After all, the International Monetary Fund predicts that the worst is yet to come for the global economy, and estimates for the US are being revised downward as consumers are expected to spend less money. Second, it was observed that wage rises could put more upward pressure on price inflation than predicted, which is not desirable, especially because demand remains robust and the labor market remains tight. Concern is that inflation will not fall since individuals are still generating too much money. Thus, without an increase in unemployment, inflation may remain high. Of course, they admit that residential investment has slowed more than other interest-sensitive pending, but they follow that up by saying that a sizable portion of economic activity has yet to show much response, giving the impression that they're expecting a broad decline across the board regardless of how much money you make. Of course, in terms of how long this may last, they stated that inflationary pressures will progressively ease in the following years, and that it would be prudent to retain that level until there was a persuasive evidence that inflation was on track to return to the 2% target. Or in other words, the expectation is that inflation will not disappear as quickly as any of us anticipated. Therefore, the Fed will continue hiking interest rates for as long as necessary, and then leave them there for as long as necessary to ensure that inflation does not re-emerge. However, in terms of what is currently happening, we must discuss the most recent inflation report, which was far worse than many people thought. All of this starts with what is known as a wholesale inflation. This is an inflation index that assesses the cost of items before they are sold to the general public, and by watching it, we can see how much prices are rising every step of the way, with the newest report providing us with some bad news. In September, it was discovered that wholesale prices jumped roughly 0.5% month after month, which was twice as much as projected and was primarily due to increasing food and energy costs. As of Thursday, October 13th, inflation was 8.2% year over year, indicating that conditions have yet to improve despite the Federal Reserve's best efforts to bring the prices down. Despite a minor decrease from August, the great majority of these gains were powered mostly by an increase in housing, food, and medical care, which were each up almost 1% month over month. On top of that, we observed a 1% increase in utility services, a 0.7% increase in new automobiles, and nearly 2% higher transportation expenses. Inflation, which includes volatile food and energy prices, was also up 6.6% from a year ago, the greatest 12-month gain since August 1982. Overall, these figures indicated that, while we aren't witnessing as much inflation as we did the previous month, prices are still rising across the board, and much of that will be influenced by global turbulence and increased energy prices, both of which threaten to push these figures much higher. That implies the Federal Reserve is currently 97% likely to raise interest rates by another 75 basis points on November 2nd, and we're also likely to see another similar rate boost in December, unless inflation begins to fall. But here's what you need to know about what this implies for the future of your money, the markets, and inflation. Because there's a lot to talk about between the US currency issue, rising energy prices, and tax cuts. Many individuals appear to be taking a wait-and-see approach while keeping an eye on the Federal Reserve and inflation, so we may continue to see a lack of growth until current levels fall. 2. As I previously stated, the housing market is in decline. The Housing Sentiment Index is near an all-time historic low, as fewer and fewer individuals believe that now is a good time to buy. As of today, we're back to the same degree of confidence that we saw in 2011, which in retrospect would have been a really excellent time to buy. But now, there's anxiety that rates are rising, monthly payments are becoming more expensive, and values must fall. 3. The Bank of England is in difficulty. They recently warned that as their markets begin to crumble, consumers will endure stress similar to the pre-2008 crisis. Higher interest rates will reduce company activity. Higher prices will result in less spending, and foreign investment will halt as people sell off their assets. This could potentially be a video in and of itself. But the central bank is no longer backstopping bond purchases as of today, which is likely to lead at a lot more volatility and increased unemployment. To me, the writing is on the wall that as companies cut back on employees, you'll be the first to go. So I'd use this as an opportunity to make myself as indispensable as possible and then keep it on emergency just in case something were to happen. But if overall, I'm feeling a lot of other investors were just relieved it wasn't worse, which is why the market is behaving the way it is. It's also worth emphasizing that we're seeing today is a lagging indicator based on data collected a month ago, so what's happening now will take another month to play out. However, one thing is certain. I'll be surprised if we don't see another 75 basis point rate hike in November, so we could see a lot more volatility in the short term. Of course, nothing makes sense in terms of what you could do about it, and even while many are calling for the S&P 500 to fall another 20%, anything may happen and we have no idea how much is priced in. So to me, the best course of action is to simply retain an emergency fund on the sidelines, stay employed, and continue investing as usual. This way, if there is a surprise Santa Claus rally, you won't miss out, but if the market falls, your cost basis will be lower. It's also a good idea to double down and make as much money as you can now while asset values are falling. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.